Hello and welcome back to AusBiz. This is the Global View on a Wednesday. I'm Andrew Gagan. Thanks for joining us. Let's check in on what happened overnight. Global investor sentiment souring as long-term borrowing costs in the US, Europe and Japan hit their highest levels in decades because of ballooning government debt and geopolitical risks. Wall Street closed lower with semiconductor shares leading the losses there. The S&P down around 0.2%, the Nasdaq down 1.3% and the Dow around 0.1% lower. Now the biggest drags came from the chip companies, including Nvidia and Micron, as well as data storage firms SanDisk and Western Digital. Shares of home improvement retailer Home Depot eased even after it beat second quarter sales estimates, while investors look forward to results due later this week from other retailers, including the bellwether Walmart. And shares of the gold miners tracked bullion prices lower as Treasury yields surged. Well, 30-year bond yields in the United States, which is the world's deepest government bond market, have hit their highest level in almost 20 years, as oil prices rose above $90 and fanning inflation concerns as the US-Iran peace hopes have faded. Elevated yields are expected to squeeze households, companies and financial markets, as well as government budgets. Meanwhile, in Japan, expectations that the central bank could hike interest rates as early as next month push 10-year borrowing costs to a 3-decade high. While in Europe, Germany's 10-year Bund yield touched its highest level since 2011, and Britain's 30-year borrowing cost neared peaks of 1998. On the data front of the US, industrial production in July rose 0.1%, a slight miss on forecast. Housing starts in July fell more than 12%, while pending home sales also fell. US yields did back off from those earlier highs late in the session, the 10-year at 4.7%. And Australian 3-year government bond yields, the futures there were at 4.58% and the 10-year at 5.07. US dollar index unchanged. The Aussie has retreated to 70.8 US cents. A quick look at what's going on in the commodities complex. And Brent crude around $91 a barrel. Gold off close to 1.8% at around $4,330 an ounce. Bitcoin currently trading at around $64,500 US dollars. Well, the AI rally has powered markets higher, but the big question now is whether the gains are spreading beyond the mega caps. Joining us is Ganti from S&P Dow Jones Indices. Anu, welcome back to you. Can we first just get your observations of what we saw on that session just gone? As I mentioned, we saw those longer dated Treasury yields certainly spooking the market.
Yes, great to be here, Andrew. And it certainly was a rough day in U.S. markets today. We had a sell-off in the S&P 500. We're seeing those longer-dated yields continue to climb, particularly on the 30-year, which reached above the 5.3% level. And the impact of this can be very profound, particularly across sectors. For example, if you think about sectors like technology, think of those high borrowing costs, particularly for some of the hyperscalers that we've seen and those increased capital expenditures. So it certainly is a potential concern right now, given the increased debt issuance that we've seen on the tech side, particularly for the mega caps. So we've seen this rotation in the past couple of days out of technology. We also saw losses today within the chipmaker space. And certainly the broadening of the market is top of mind as investors seek refuge in other sectors, perhaps more defensive sectors.
Well, to that point, just talking about the broadening, I guess, of what we're seeing there. So obviously we did see some recent highs there, particularly in the S&P 500, because the prospects of imminent rate hikes has been reduced in the wake of what we heard from the Fed, but also that soft jobs report as well. But to your point, the tailwinds from the market there, just as far as the broadening of performance beyond the mega cap hyperscalers, what are you seeing?
Yeah, so there's a couple of things that we're seeing here. To give you a couple of stats, we saw that more than 60% of stocks in the S&P 500 beat the index in June and July. So we certainly saw that broadening. Very similar results for our equal weight index, which is the same 500 companies, but equally weighted. It has a smaller cap bias without the exposure to small companies. You see it right here on this chart, right? Outperformance in June, outperformance in July. If the trends that we see today continue, potentially we could continue to see that broadening within the overall market. Another trend is just if you think about earnings season that we've been closing out in Q2, more than 80% of companies beat estimates, EPS estimates. And these were companies not just situated within technology, but sectors like healthcare, industrials, materials, for example, and real estate. So the broadening of the market has been a trend for the past couple of months. You're looking at the earnings estimate chart right there. So that's certainly evidence that fundamentals have been sound and healthy within this market. Of course, we may not be out of the woods yet. Inflation concerns are top of mind, geopolitical concerns with rising crude oil prices. So the energy sector will be interesting to watch as well.
Well, speaking of that, then I was just going to ask you, Anu, then what are we seeing as far as those sectors that are perhaps emerging as potential leaders as we see that rotation, particularly out of tech?
Yes, a couple of sectors that we're watching is if you think about the equal weight index outperformance, one of the drivers has been the index's overweight to energy. And of course, energy has just been a natural beneficiary of the rising crude oil prices that we've seen. Another trend is if you look under the hood within technology, our equal weighted technology index has outperformed the cap weighted technology index. That tells us that smaller companies within the tech sector have benefited. And again, going back to the earlier point about rising treasury yields, which can weigh on some of these large hyperscalers that are issuing a lot of debt, perhaps the smaller companies within the S&P 500 technology have standed to benefit here. So those are a couple of sectors that we've been looking at closely. Overall, also, if you look at volatility, dispersion within the S&P 500 and S&P 500 equal weight has trended higher as increasingly market participants have been scrutinizing the winners and losers of the overall AI value chain trade. So we've seen that the benefits of the AI trade have no longer been concentrated in just technology and just the chip makers, but the overall market.
Well, and what did we learn out of earnings season? I know, given pretty much at the end or near to it, mind you, we do have one of the biggies to come in Nvidia. But what is that telling you about the strength in the market overall?
Yes, it's telling me a couple of things. One is that the fundamentals appear sound right now. If you think about companies like healthcare, for example, a lot of these sectors tend to get overlooked with the focus being on technology, with the focus being on semiconductors. But overall, broad-based fundamentals have appeared sound. The other trend to look at is you saw the chart earlier that more than 80% of these companies beat their EPS estimates. It was actually higher than what we saw in prior quarters. So it was a positive sign. The other positive sign is that a lot of the companies issued positive forward guidance. And of course, there remain a lot of uncertainties right now with inflation concerns bubbling up again, with rising crude oil prices, which can weigh on a lot of companies within these sectors. So there certainly still appears to be uncertainty and concerns for a lot of these companies.
So potentially with investors trying to pick those winners and losers at the moment, what does that rising market dispersion tell you?
Yes, dispersion is an indicator that we look at very closely as far as opportune conditions for active managers. In fact, we recently released our institutional SPIVA scorecard where we measure active manager performance, and we also do it for institutional managers. If you think back to our classic SPIVA scorecard, we saw that 79% of large cap equity managers underperformed the S&P 500. Now, if you look at institutional accounts, we saw that they did slightly better. 67% of them underperformed. But if you look at the long-term results over a 10-year period, the results were very consistent, regardless of vehicle. Also, another notable point is last year in 2025, thinking about these results, we were in a very similar space with rising dispersion, broadening of the market, but it was still tough to beat the benchmark. So very similar conditions that we're in right now.
So, Anna, given that SPIVA report card, then what are the implications you're seeing there, I guess, particularly for institutional investors?
Yes, I think one of the implications that we're looking at is just the rising fund dispersion. So the spread between manager returns also rose in 2025. In fact, it rose across every single equity category that we report on. So potentially a signal of just greater asset owner risk when selecting managers. So something to keep in mind for the institutional community. And it's not surprising that we saw the higher fund dispersion given the rising market dispersion that we just talked about. We also saw mixed results within the fixed income space, and particularly in the institutional side, fees can make a difference on the fixed income side, so which is another important indicator for asset owners to pay attention to. But again, regardless of vehicle, whether it was mutual funds or institutional accounts, we have seen that consistent majority underperformance, which tends to go up the longer the time horizon.
Anu, thanks so much for joining us from S&P Dow Jones Indices.
Thank you.
Let's now turn our attention to the local market ahead of the open on this Wednesday. Then we're expecting another negative start. That has been a trend, obviously, for the past 5 sessions or so. SPY futures off around 0.25%. But those market moves very much driven by what we're seeing with individual stocks having reported. We got some big ones yesterday, of course, and the likes of BHP and CSL, and many more to get across today. We'll do that in just a moment. Stay with us for the open.